Welcome to a Cofi with the FinTech Pod. We'll explore the latest trends, innovations, and ideas shaping the financial industry. Join host Alex Irigoyen as he interviews leading experts in the field. Learn from top CFO, tech leaders, investors, and many more. Join us and get inspired. Let's get started.
Hi, everybody, and welcome to an episode of A Coffee With. This is going to be our third episode, and today we have as a guest Luis Rietti, Senior Finance Director at Harver. Thank you very much for joining us today, Luis, and welcome to the pod.
Well, thanks for having me. Happy to be here.
Awesome. So first of all, I would like to share a bit of background on your story. You started early your career in sales. Then you started your own boutique for finance. You did the MBA at Wharton, probably one of the most successful MBA programs out there in the world. After that, worked at private equity, and now we see you leading finance, the finance department at Harver. I don't know, Luis, if you could share some context about how this process has been. How did you start in sales and move to finance?
Yeah, of course. It's a non-traditional path. I don't think I've met anyone else who's ever done that before, but I'm thankful that I had the chance to do that, because I feel like I got pretty much two opposites in terms of experience in business. I started out in sales really because I was an immigrant to the US like you, Alex. I'm originally from Honduras. And I thought that in sales, I would have the best opportunity to cut my teeth, to understand pretty much how business is done in this country, in the US, and be in the front lines. So sure enough, that was accomplished. It was very much trial by fire, as they say. But I enjoyed it. It was a good experience in which I was able to really understand, the power of go-to-market and sales, and what really propels a company to grow. In my sales career, I started out very much in entry level, very traditional sales roles, but as time evolved, I think I was in sales about 5 years. But at the end of that stretch, I was able to get into a more strategic role in sales, which is what I really enjoyed. And I was working here in Austin for a high growth startup, lead generator. I think within the first 3 years after launching that company, they hit 100 million in revenue. So really, really fast growth. But I was given a revenue channel to manage. And what I really liked about this company was they were very data driven. And this was in a time where not everybody was doing that in the tech world. And so I started to play with our databases and taught myself to write SQL queries and work with Excel. And essentially, I started to create models because I wanted to optimize my book of business and how to best grow it. And eventually, I pretty much created some pricing strategies and worked with the product team and the BI teams to develop, some better product strategy. And all of that was very rewarding and achieved really positive results. But that was really why I decided to change, because I got a taste of the power of working with data and numbers. And so I decided I wanted to pivot my career. And I didn't know how to do that except by starting my own company, right? So I started an advisory company in which I first was helping some previous clients of mine manage their lead generation campaigns, and also I would say really more on the operations and strategy side, how to optimize go-to-market for growth. And inevitably, as I worked with these clients, most of them, small companies, right?
Yeah.
We kept running into the issue of raising capital or potentially selling, right? And so that's where my clients kept coming to me for help and asking me to help them understand what to do, make decisions, and even to deal with potential investors. And so I kind of self-educated in all things private equity and venture capital, as well as just corporate finance. That was really an interesting phase in which I was able to help several companies either raise around or to sell the company altogether. And this was really, I would say, the inflection point within running my own company where I decided, okay, I want to really get into finance, right? And so outside of the work I was doing, really you could call it pseudo an investment banker, right? I was a middleman in which I was not only working with startups. Now I was also working with private equity firms and helping them not only source investments but also vet them and even create models. Obviously, I was working with less sophisticated private equity groups, family offices, and that kind of operation. And so around this time is when I decided to go to business school. I was fortunate to get into Wharton, which at least at the time was ranked #1. So of course I had to accept. It was a great experience. I learned a ton. And then I was like, okay, I'm ready, right? I'm ready to really get into finance. I got a private equity role coming out of business school, which was really interesting, really being on the other side, right? From the investor perspective, which is really completely different. But to be honest, I kind of missed being on the side of the company, on the operating side. And so after that private equity stint, I decided to take a role with a SaaS business. They brought me in really to help drive their M&A strategy, their corporate development strategy. That's my current company, by the way, that's Harver. And then eventually that role transitioned into also absorbing the FP&A group and growing that group as well. So wearing a lot of different hats, and here I am today.
That's awesome. Thank you very much, Luis, for sharing. Definitely a very exciting career. So Harver is a software company, part of the group. It's owned by private equity. I don't know if you could share with your experience, what are the difference when you have to do the reporting to private equities and you work in finance for a private equity owned company, and the difference where you are not owned by a PE?
Yeah, there's some pretty significant differences because the ownership structure determines first the growth trajectory, right? Like, how do you want to grow? How quickly do you want to grow? What are you willing to invest in? And then separately, I would say that the biggest difference is also the ongoing reporting cadence, right? The back and forth. Private equity firms are usually much more involved than venture capital or just like a privately owned company that does not have institutional investors. I think that the delicate balance that a PE-backed company has to manage is to be able to make its own decisions, like the executive team, to have the autonomy to make the calls that they think are best for the company, while at the same time respecting the interests, I would say, of the PE company, as well as the expectations, right? Because every PE firm has a portfolio of companies, and they have their playbooks and their preferred strategies, right, that they leverage strongly. In our case at Harver, which I think it's becoming more and more common in PE-backed companies, is that we are what you call a platform portfolio company, which means that we were acquired by a PE firm with the intention to grow through M&A and to acquire more similar competitors and add them on top of our company to make our company the platform of record. So yeah, a lot that we could go into here in terms of private equity, but I would say that it's usually, it could be very beneficial, for a company, because there's a level of sophistication, when it comes to business planning, creating a budget, even, defining go-to-market strategies, all that, right? Like a PE group is going to require much more rigor, in making decisions.
That's awesome. So definitely through PE, you have to do constantly doing different acquisitions, different M&A operations. How do you feel right now about the tech M&A market coming into 2023? Do you see changes in trends? Do you think that since valuations have dropped, this is going to lead to more M&As? How do you see this?
Yeah, I think that the M&A market's changing very quickly. Obviously, there are some macroeconomic trends that are really affecting valuations. There's a compression of valuations overall, and at the same time, a subset of companies, I would say, valuations are increasing because there's more competition for, of course, profitable companies now. So, the vetting and the metrics that are used for evaluating companies are changing very quickly. And of course, we're moving from revenue-based multiples very quickly into only EBITDA or profitability multiples, which is really a massive change, in my opinion, especially for the SMB sector, right? Like the small companies. I would say another trend that is changing is how demand for technology, whether it be B2C or B2B, is also becoming more nuanced, and there's more variety, I would say, because remote work is here to stay. You're usually selling to global clients now. Industries are just changing very quickly, and so I think that companies are having to rethink their target markets, their positioning strategy, and of course, this means that private equity firms are also really taking the time to study. If we're gonna go acquire through M&A, it's no longer let's just buy a customer base, or this product could be a nice to have to add. You really have to think about how this affects the positioning of the company. So in my opinion, M&A activities is, I would say, positioned to increase because they're due to the limitations of organic growth. I think it makes more sense, especially when there might be opportunity to acquire small companies that don't have capital, right? That maybe these small companies would have held on longer, but maybe they're running out of cash. So, or they want to be better positioned to grow with a larger owner. So yeah, I would say that the M&A market's going to heat up. And I'm very curious to see how, the different segments play out.
Great. So I wonder, Luis, definitely in a M&A transaction, there's a due diligence process that you have to go through. We've seen in the news lately that many of those due diligence have been very, very bad. Definitely a terrible job that led to a lot of millions in loss. How was this due diligence process when you were working at the PE? What type of things were you looking for, and how does it help you integrate in a company already like Harver?
Yeah, there's a pretty wide array of types of due diligence. I think a lot of it has to do with the deal itself. And what I mean by that is sometimes when there is unique access to a deal, that you don't want that access to be open to others. A buyer has to move very quickly, and because of that, right, like that really increases the pressure of due diligence, and a lot more work is done in a lot less time. It's very different if you are a part of an open bidding process that has clear, timelines, or if you have a unique relationship with a seller, right? That there's no real rush, that there's the availability to take time. In my opinion, the least successful due diligence processes are driven usually by a decision maker on the buying side, whether that's a CEO of the M&A buyer or even the private equity group, that is really passionate about a target company. And the passion comes from a unique perspective, or because there seems to be a pricing arbitrage, meaning they think it's underpriced, or it's a premium asset, right? Meaning it's hard to get. And then they kind of overlook the fundamentals, right? They overvalue the strategic positioning of the company, and they undervalue the economics, the model, the due diligence, right? And so in those instances, usually, right, there's always a model created. There's evaluation of a book of business, financials, and management audits, and third party diligence and quality of earnings studies. But at the end of the day, like, the decision's already made, right? So all that work is kind of just to make sure there's nothing terrible. But in a good due diligence process, in my opinion, there is the ability to really identify the reasons why the company is being purchased, and a validation of each one of those reasons, right? And not just a theoretical validation, but a validation with the data, right? So it's a very thorough process in which difficult questions are asked and assumptions are made, but at the end of the day, a buyer has to be willing to walk away.
Awesome. So right now, Luis, you're leading the FP&A team. I can imagine that you are in charge of all the forecasting, budgeting, and planning process. So I wonder, in a situation like this one, that the environment is constantly changing, right? So from the COVID to the recession now, in the last few years, it's very changing. How did the forecasting and the planning task evolve, having in account that pretty much every day now we have different news, very strong news, and are changing this landscape for businesses?
Yeah, it is definitely a big challenge, forecasting and planning right now. What we have focused on is to aim for greater accuracy in the short term, and to refine and optimize the process of forecasting, to add more data points, to rethink the forecasting models, right? To not rely on okay, this is what we did in the past, and these are our pipeline metrics and our marketing metrics and so on and so forth, but to assume that those metrics are not necessarily going to hold for the rest of the year.
Yeah.
Right. And so a lot of scenario planning, and a lot of, I would say, stress testing is what I would describe. At the end of the day, a forecast is always wrong. But what we want to do is to have a forecast that makes us ask the right questions, and helps us be prepared for potential difficulties and hopefully mitigate those difficulties, or on the flip side, to recognize growth opportunities, right, and then to leverage those.
Awesome. And you mentioned, Luis, about the drivers. So which are the drivers that right now are you checking, and how do you measure these different drivers and metrics for the private equity and internally, right? I imagine that there's some of these metrics that the private equity is asking, and internally there's some others. Are they the same? Are they any different between each other?
I think so. That depends on the PE firm, right? Like, I don't necessarily think I want to generalize, but for example, in our case, we currently internally have more operating metrics that we review, and then when we are presenting to the PE sponsor, they are consolidated into the more important metrics. And from the PE side, I would say that, yeah, every PE firm has their benchmarks, their metrics that are benchmarks against, expectations of bottom performance, top performance, so on and so forth. In the SaaS business, I would say a really big metric and sub-metrics that drive a lot of performance focuses around retention. And so, you can slice and dice retention 50 different ways, right? And we do actually, we do like to have a lot of different dimensions to measure retention, and at the same time, net retention, right? Not just gross retention, but how are we able to grow our business as well, right? Because it's always cheaper to get new bookings from a current customer than a new customer. And then outside of that, we focus a lot on new bookings. So our pipeline metrics, our acquisition costs, our CAC ratios, LTV, I would say how we're trending on our annual contract values, obviously growth period over period. I'll add another category that I think is interesting, which is more SaaS categories, like the SaaS quick ratio, or the magic number, which essentially is a proxy for growth as well. But at the end of the day, it's really focused on the growth, right? The front of the business. Increasingly, though, I will say that growing profitably, right, is becoming more important. So the rule of 40 is becoming more prominent as a metric, and all profitability metrics, right? Like EBITDA margins and all things profitability. Add backs becoming more important as well, because adjusted EBITDA also becoming more of a focus, especially if you're doing M&A, because there's a lot of one-time costs and costs that you're winding out or you're eliminating. So yeah.
Awesome. This is super helpful, Luis. Thank you very much for all the explanation about how a software company backed by a private equity works. I think this is going to be super helpful. I would like to ask you one last question. Our previous guest, Brian Pushifer from Continue, he left a question for you. So he asked you, what are you actively learning right now? And it can be either personal or professional.
Yeah. What am I focused on learning right now? So I think that, I'm really interested in this new era of business where things are changing so quickly, how to continue to drive growth. As someone in finance, usually, finance probably people think that is about just reporting and accounting and delivering results, which is true. But there's a strategic component in finance that I really enjoy, right? Which is using financial and operating data in order to not just create models, but to help support the executive leaderships or the management teams to make the decisions that benefit the company the most. So, I'm always very interested cross-functionally, you would say, across the business, in what product is doing, what are we doing in R&D, what's obviously the go-to-market team, in terms of the different parts of the go-to-market team, what's working, what's not working, our operations team, how are we optimizing our tech stack, our visibility into data, maybe our allocation of client success time. So yeah, I'm a very curious person, and I like to understand how the machine works. So yeah, like I said, with how the world is changing so fast, I think a lot of the old paradigms and ways of doing things need to change, and I'm very open to that.
Awesome. This is very, very helpful, Luis. Thank you very much. For the people that would like to connect with you, where can we connect with you? Through email, LinkedIn?
Yeah, you can do both. I'm on LinkedIn. I'm the only person with my name in the world since my grandfather passed away. But you can email me as well, luisrietti@gmail.com. So it's a very easy email.
Awesome. Luis, so thank you very much for being today in the pod. It's been a pleasure. We learned tons today. So thank you again, and we hope to have you soon again.
Thanks, Alex. I appreciate it.
Awesome. Have a great day. Bye-bye.
You too. Bye.